Did you know that passive fixed income ETFs only capture about 50% of the U.S. public bond market? But with JP Morgan Asset Management's active fixed income ETFs, we can help you capture 100% of the U.S. public bond market and explore twice as many opportunities. Visit jpmorgan.com/getactive to learn more. JP Morgan Asset Management is the brand name for the asset management business of JP Morgan Chase & Co. and its affiliates worldwide. This communication is issued by JP Morgan Distribution Services Incorporated, member of FINRA.
How can you grow your business from idea to industry leader? Bring your vision to life with smart business buying tools and technology from Amazon Business. From fast, free shipping to in-depth buying insights and automated purchase approvals, they deliver everything you need to achieve your goals. It's not easy to stand out from the crowd. Simplify how you stock up to get ahead. Go to amazonbusiness.com for support.
Being a small business owner isn't just a career, it's a calling. Chase for Business knows how much heart and effort go into building something of your own. Manage all your business finances, from banking to payments to credit cards, all in one place with their digital tools. Plus, access online resources designed to help your business thrive. Learn more at chase.com/business. Chase for Business. Make more of what's yours. The Chase mobile app is available for select mobile devices. Message and data rates may apply. JP Morgan Chase Bank N.A. Member FDIC. Copyright 2025 JP Morgan Chase & Company.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, as earnings season continues, we take a look at the impact on markets, plus big tech earnings in focus. I'm Nathan Hager in Washington.
I'm Stephen Carroll in London, where we're looking ahead to the challenges facing the Bank of England and its next interest rate decision.
I'm Doug Krisner, looking at a challenging decision on rates for the Reserve Bank of Australia.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager. We begin today's program with a focus on the market. We're more than halfway through third quarter earnings season, and with stocks still finding ways to set records, what's the outlook for the week ahead and for the final 2 months of this year? For that, we're joined by Amanda Agati, Chief Investment Officer at PNC's Asset Management Group. Amanda, it's great to have you with us on this weekend show, and I know you've been pretty positive on the earnings picture thus far. How do things look to you now that we're at the point that we sit at now?
Well, it's always great to be with you. Thanks so much for having me. We're feeling really positive about this stage of Q3 earnings season. It was actually a pretty positive setup even before earnings season started. Very strong, sort of consistently positive revisions over the course of Q3. So we set a pretty high bar coming into earnings season itself. And believe it or not, at this stage of earnings reporting, we are handily exceeding it. So by my math, we were expecting about 7.2% earnings growth for the S&P 500 before earnings season started, and we're tracking well in excess of 9%. So I'll give it an A grade so far. There's still some distance to go yet, but that's a pretty strong result, and I think it's been enough to support the market, certainly at these valuation levels.
So now that we're through, some of the biggest big cap names to report so far this season, what are you looking at in terms of whether we could see this momentum continue to build?
Yeah, the most critical thing is what happens with revisions for Q4 and even for 2026. And so because the results that have come in so far have handily exceeded that high bar, it's actually pushing revisions up for the balance of the year and setting the stage for, well in excess of 13%, maybe 14%, not to get too superstitious with you in terms of earnings growth for next year. So it's really all about the trend. It's not so much here and in the moment. It's sort of how is this setting the stage for what's to come. And I think the market is very focused on what happens over the next 4 quarters and certainly what happens with the Fed. So we're getting a good result here, but the trend line is really what matters.
Well, with the stock levels as high as they are right now, Amanda, could we be due for a pullback?
Oh, well, I mean, a pullback is always a possibility. It's sort of normal, natural functioning market health and behavior. We haven't had much of a pullback more recently since that V-shaped bounce we had in the springtime. So I always say yes to that question, but that doesn't mean that I feel particularly concerned or, bearish about the backdrop right now. Valuations are pushing it. I would describe them as sort of pricing for near perfection. And the backdrop is clearly not quite perfect. There's still a lot of purple haze of policy uncertainty there. So with valuations at these levels, it just doesn't give the market a ton of headroom when some noise comes into the backdrop. So do I think things get a little choppy from here? I think that's possible, but we've been in a period of pretty low volatility. And so seeing a little bit more volatility actually makes me feel better about the sustainability of the rally going forward.
We've talked before about the purple haze of policy uncertainty. We're just coming out of a very important meeting between Presidents Trump and Xi Jinping of China, where they got that 1-year trade truce. Does that lift some of the fog for you, or do you see more potential for uncertainty to come?
Yeah, I think it helps on a relative basis. We definitely, as it relates to trade and tariffs in total, we definitely feel like the purple haze has lifted a bit. It's more of a narrow band in terms of best and worst case kind of scenarios. And so that, I think, has really helped the market kind of wrestle with that, try and assign some level of a PE multiple and kind of move past some of the worst case scenarios that we were worrying about and anticipating in the first half of the year. But this purple haze is not just about tariffs and trade, right? We have a government shutdown looming pretty large here, right? And so key questions around when, how, if the shutdown is going to come to an end, that is creating more, I think, near-term purple haze for me. And to some degree, I think it will start to weigh on the market. It hasn't yet because the market typically kind of ignores these things, but this one's going on a bit longer than what I think anybody engaged in this would like to see. So that's a little bit of near-term purple haze that we're watching carefully. And then, of course, with the Fed meeting earlier this week, Powell throwing some cold water on what happens in December. That's adding a little purple haze of monetary policy uncertainty, too.
And that's Amanda Agati, Chief Investment Officer at PNC Asset Management. Now let's take a closer look at the big tech earnings we saw this past week and what they could tell us about markets going forward. For that, we're joined by Ivan Feinseth, Senior Partner and Chief Investment Officer at Tigris Capital Partners. It's great to have you with us on the weekend program, Ivan, after we've heard from 5 of the Mag 7 names. I think we could probably say it was a mixed reaction. Was it a mixed result for you?
No, I think everything is going well. I think that the pullback in Meta platforms is definitely a buying opportunity. They continue to invest in advancing AI, and it will continue to pay off as it has in the past. So I still say we are in the first inning of a huge AI World Series. This bullish investment trend has a lot more to go, and I'm going to say every company is going to invest in AI, and every company is going to be an AI company that's going to drive their business, whether it's supply chain management, whether it's price optimization, whether it's finding new leads and generating marketing initiatives. AI is going to be an engine behind multiple aspects of every company.
Just to play a little bit of a devil's advocate on that, I wonder, though, whether after we've seen some of the market reaction to these results this past week, whether we're going to see a sort of a split as to how some of these biggest names see that AI investment pay off.
There's always going to be bumps in the road. And remember, these companies are investing for the next, 3-5+ years. And the AI engines that we have now are going to pale in comparison to what we have in the future, as we're still in the early stages. So there's going to be new technologies emerging that will overtake maybe some of the previous technologies, and companies will continue to learn as the large language models will continue to learn and create these data factories that create the data that they will learn from.
Certainly an arms race. We've seen that in terms of the reported spending, tens of billions of dollars by just about every company that's reported in this past week. Where do you see things stacking up in terms of the race? Who's winning, who's placing, who's showing?
Certainly, Amazon is winning, Google is winning, Microsoft is winning, and Meta is winning. And then the companies that use their platforms will also start to win as well. Companies that use, for example, the travel industry to use AI for optimum pricing for airline tickets, for hotel rooms, for cruise line tickets. So there's going to be a lot of different ways to win and a lot of different ways to use the technology.
We certainly saw Amazon Web Services kind of hit things out of the ballpark with their 20% year over year growth number for Amazon Web Services, sort of staying in the lead in terms of the cloud. Do you see any market shifts in that cloud business around, some of those big players we've been talking about like Amazon, Google, and Microsoft?
They're going to continue to gain market share and customers between the three of them. Remember, large companies they use more than one platform because you need backup, you need redundancy, and each platform is going to have the strengths and weaknesses that companies are going to need, where they want to have the fastest processors for some inferences, and then secondary, tertiary processing for other functions. So it's not a zero-sum game amongst the cloud service providers. And then you got, of course, the GPUs that power all of this coming from NVIDIA, and NVIDIA wins on every front. And when they talk about another company catching up to, by the time a company catches up to NVIDIA's current processor, they already have multiple new processors in the pipeline. When other competitors catch up to the Hopper, they got the Blackwell. They catch up to the Blackwell, they got the Rubin, and when they catch up to the Rubin, the next one is the Feynman. So NVIDIA thinks multiple steps ahead, and NVIDIA's power is that they have the software that's used to get the value and the processing power from their processors. Their CUDA software is a big driver of their GPU processors.
Yeah, let's talk a little bit more about NVIDIA, because we've seen the CEO, Jensen Huang, making a lot of deals this past week at the APEC Summit in South Korea, investing into AI startups as well. What's your read on some of the latest moves that Jensen Huang has been making in terms of investment?
He just is staying steps ahead of everybody. He's sinking into the future. You want to be on the forefront of every front and be ahead of the curve, and he's doing that. And there is a lot of money that will be invested in various startups that help to train the AI process. So it makes sense. NVIDIA is a large investor in a lot of different emerging technologies. And then some may emerge and go on to be industry leaders. Some may not, but that's the kind of venture capital investing game. But then they also benefit that they become NVIDIA customers as well.
And, going into all of these earnings, there's been the debate about whether these companies are spending and whether investors are spending into an AI bubble. Now that we've gotten through these earnings, where do you sit on that debate?
As far as it's a bubble?
Yeah.
It's not meaning that that this is a fad and the bubble will burst no, it's not a bubble. Things may get ahead of themselves from time to time, and stock prices may run up and then pull back, but it's not really a bubble. It's a powerful trend that will continue to move forward. Just like, there were some bubbles in the beginning of the internet in the 90s, but now there were many other competitors to Amazon. There was eToys and Pets.com, but look at where Amazon is today. Look at where Microsoft is today. Look at where Google is today. Look at where Apple is today. So there will be huge winners into the future as well.
Appreciate this, Ivan. Thanks again for being with us.
Thank you.
That's Ivan Feinseth. He is Chief Investment Officer at Tigris Capital Partners. And coming up on Bloomberg Daybreak Weekend, Bank of England policymakers are meeting this week for their latest interest rate decision. We'll get the details from our team in London. I'm Nathan Hager, and this is Bloomberg.
Did Did you know that passive fixed income ETFs only capture about 50% of the U.S. public bond market? But with JP Morgan Asset Management's active fixed income ETFs, we can help you capture 100% of the U.S. public bond market and explore twice as many opportunities. Visit jpmorgan.com/getactive to learn more. JP Morgan Asset Management is the brand name for the asset management business of JP Morgan Chase & Co. and its affiliates worldwide. This communication is issued by JP Morgan Distribution Services Incorporated, member of FINRA.
Okay, creativity and organizing ideas don't always go together, but Canva brings them together seamlessly, and it adds so much. It's like this. You've got a vision, great idea for, let's say, a presentation. The presentation in your head is a 12 out of 10. Standing ovations for you and your boss. Raises all around. But turning the presentation in your mind into an actual presentation? Something else entirely. There are like 24 complicated apps involved, not enough time, and to be honest, you don't really know what you're doing. With Canva, you can bring all your ideas together in one place with one app. Use AI to speed things up and bring other people in to help, because teamwork makes the team work. I might have gotten that wrong. Point is, your presentation will look great. You'll look great. Everybody will look great. And isn't that what you're after? There's a reason 95% of Fortune 500 companies use Canva. Canva lets you bring your ideas to life as fast as you can think of them. Put imagination to work at canva.com.
Hiscox Small Business Insurance knows there is no business like your business. Across America, over 600,000 small businesses, from accountants and architects to photographers and yoga instructors, look to Hiscox Insurance for protection. Find flexible coverage that adapts to the needs of your small business with a fast, easy online quote at hiscox.com. That's HISCOX.com. There's no business like small business. Hiscox Small Business Insurance.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in our program, we'll turn to Australia, where core inflation accelerated beyond expectations last quarter. But first, Bank of England policymakers are meeting in the coming days for their latest interest rate decision. Investors are not expecting the UK central bank to cut rates, but the recent data have made the path ahead less clear. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Nathan, the Bank of England is becoming something of an outlier among its global peers. The ECB appears to have finished its rate-cutting cycle, while the Federal Reserve is continuing on its easing path. But the BOE's base rate is still 4%, and that doesn't look likely to change in the coming days. Although Goldman Sachs economists are calling for policymakers to reduce interest rates at their next meeting, that's bucking the market consensus that the central bank will keep rates on hold. On the data front, inflation held steady at 3.8% in September, which is less than economists had forecast, but still well above the central bank's target. November's budget could add to the uncertainty over price pressures, something the Chancellor Rachel Reeves acknowledged in recent days as she addressed a gathering of business leaders in Saudi Arabia.
Look, for me and my government in the United Kingdom, our number one priority is growing the economy. But we need to do that on a sort of a foundation of stability. And we do live in a more uncertain world. We can see that all around us, whichever newspapers and TV channels we watch. That uncertainty, whether it is higher tariffs, whether it is conflicts around the world. And that's why building relationships with our allies is more important than ever to build that security and resilience into the system. That's why in the United Kingdom we put real focus this last year on securing trade deals.
So that's the Chancellor Rachel Reeves there, speaking to some of the backdrop for this upcoming interest rate decision from the Bank of England. How will policymakers balance the data and the broader economic concerns? Our chief UK economist Dan Hansen is with me now to discuss. Dan, let's start, I suppose, with the concrete parts of this and the data. What are the signals that we have from those numbers the Bank of England will be watching?
Yeah, so you mentioned it at the start there. I think you've had slightly weaker than expected inflation, but the key point, and you said it, is inflation is still almost double the Bank of England's target. But But there has been, there was good news in that September print. It was a little bit weaker than expected. And it's always one of these things of, should we look at the level of inflation, which we probably should, or should we look at what inflation did relative to forecasts? And that tends to be how markets respond. And markets have responded quite dovishly to that inflation print. You take that alongside, we've had data on growth that's been probably a touch weaker than the bank expected, but they haven't been placing a huge amount of weight on the growth data. The pay data has been weaker than expected, and that's important. And that's something that, at least in August, the bank focused on when it cut interest rates.
And we've something that Andrew Bailey has brought up sort of repeatedly over the past couple of years, is that it's one of those things that has made the UK situation particularly, I suppose, challenging for the Bank of England, is that wages were rising at pace, which was adding to the complication.
Yeah, and exactly right. And what's happened since the peak of wage growth is that wage growth has slowed, but it has slowed quite slowly. And that has meant that the bank has been cautious about how fast it will cut interest rates. I mean, if you think about where we are at the moment, private sector pay growth's running a little under 4.5%. We need pay growth in the UK, or the Bank of England, I should say, needs pay growth in the UK of around 3% to hit its 2% inflation target. So there's still some way to go. One really positive thing on this front, at least if you're an inflation targeting central bank, not if you're a household, is that indicators of pay growth are pointing downwards, forward-looking indicators. So pay settlements and the like are pointing to pay growth closer to that 3% mark. But it's still early days for 2026. Not a lot of people know what their pay rise is going to be for 2026 yet. That information will start coming through in the first quarter of next year, and that's something the bank will be focused quite heavily on.
Okay, so essentially, is that why you don't think the bank is going to cut rates at this meeting? The market expectations have moved a little bit, but the general consensus is no move this time around.
Yeah, so we saw a little bit of movement on the change in the Goldman call that you mentioned. Not a huge amount, but a little bit. It seems to have come back now. So we've got maybe 4 or 5 basis points price. So 20-25% chance of a cut. Obviously not very high. Our view is that there has been dovish news in the data, particularly in the prices data, but the fundamental point is that inflation's still nearly double the target. You've mentioned the budget. That is a huge element of uncertainty. We saw what happened last year with the budget, and there is no reason, given where interest rates are, they're at 4%, but there's probably not a huge amount of distance for the bank to travel before they finish cutting interest rates.
Yeah.
Skipping a meeting is not really a big deal, just to wait for that, particularly that information about the budget, but also for your own credibility as a central bank. Cutting rates when inflation is 3.8% is quite a hard sell. Even if there is a story to be told about perhaps the labour market is loose, pay growth is coming down, pay growth is still above the levels that are consistent with the 2% target. Inflation is still high, so you've got time on your side. And so that's why I think they will hold at this upcoming meeting.
And you mentioned the budget there, of course. The big change that did impact particularly price pressures was the increase in the payroll tax for employers, and that was something that took us a bit of time to see coming into data. Do we have the full effect of that now? Is everyone sort of aware of what effect that increase in employers' national insurance had now?
I think we're nearly there with it all passing through. I think by the end of this year it will be in the data. Teasing it out from everything, all the other noise that's been going on is very, very difficult. But I think you can see that, yes, there was an impact on employment. Yes, there was an impact on prices, possibly an impact on wages, less sure. But I think it appears to have flown through into the data now. Looking to the budget, what the bank will be watching is not just, I mean, there are a lot of things it'll be watching. Yeah. First of all, it'll be the profile of the fiscal consolidation that Reeves announces. Yeah. What matters for the bank is where the consolidation lands, because the bank only thinks 3 years ahead.
Okay.
And the fiscal forecast is 5 years. So if the Chancellor puts it all at the back end of the forecast, it means nothing for the Bank of England. Point 2 will be, it's most likely going to be tax rises. We know that. Fine. Then it's whether it's indirect tax increases. So that played a part in the inflation story this year as well. Vehicle excise.
Because something like VAT is being floated as a possibility. Of course, we're still waiting, and we're several weeks away from the budget, and the government's promise has been that they wouldn't raise income tax, national insurance or VAT. The question of whether or not that position might be shifting still very much in the debate, so we won't dwell too much on it. But a VAT increase would presumably be particularly bad news for inflation.
Absolutely. So indirect taxes, VAT, vehicle excise duty, fuel duty, all of those things would flow straight into the CPI basket and make the Bank of England's job much harder. I think Rachel Reeves, listening to her rhetoric around this budget, she's very conscious of the inflation story now. And I think probably in hindsight wouldn't have gone through with some of the policies she went through in October last year in the budget last year, because there has been an inflationary impact. Thinking about not just the national insurance increase, you're thinking about the minimum wage, you're thinking about what happened with, let's say, with vehicle excise duty and other components of the CPI basket as well. So what I think you'll see is policies announced in the budget, at least, that will be disinflationary. But the point for the Bank of England is it just wants to know that they're disinflationary. And that's a reason not to go ahead and cut interest rates just now. But think about when to cut interest rates. People are talking about December. For me, that still feels a little bit too soon. I think it'll probably be in the first half of next year.
Is there anything that the Bank of England can do to help the Chancellor in her job as well? I know that's not their job, but just, given that obviously the influence on borrowing costs is important and does matter when it comes to the very constrained fiscal situation the British government's in.
Well, I mean, they could stop quantitative tightening straight away if they wanted to directly help the Treasury, but obviously it's an independent central bank, so they're going to do what they're going to do. I mean, the key point for the fiscal forecast will be the window. So the OBR, so the UK fiscal watchdog, takes a snapshot of the market curve into its forecast, and the key point will be what window has it taken for its forecast, and whether we've had a fall in gilt yields recently.
Good news for the Chancellor.
Good news for the Chancellor, exactly. Whether that makes it into the OBR forecast, there's a lot of uncertainty about that. So that's directly how the Bank of England can impact or make Rachel Reeves' job easier, is by cutting interest rates, being dovish, pushing down on long-term borrowing costs, pushing down on short-term borrowing costs as well, because that affects the debt interest picture.
Yeah.
Beyond that, I think we heard there from Rachel Reeves about the government's priority is to grow the economy. Of course, a big fiscal consolidation, so the government raises taxes, that makes it more likely the Bank of England cuts interest rates. But that's very much a short-term story. And I think what Rachel Reeves is talking about is the supply side, the long-term trajectory of the economy. Can the economy grow faster permanently? And they're the policies that the government is focused on. And monetary policy can't do much about that. Yeah. That's very much about supply-side reform and also about the makeup of tax in the UK as well.
Coming back to this Bank of England decision, I mean, how important is the vote split going to be when it comes? Are we expecting a divided monetary policy committee?
Well, one thing that's going to be really interesting about this is that a speech a couple of weeks ago by Hugh Pill noted that the minutes are going to have a section for each policymaker to explain their thinking, which is something we haven't had from the Bank of England before. So we're going to hear from all 9 of them about exactly how they are thinking about it. So up until now...
It'll be fun for you.
Oh, yeah. I mean, I can't wait. Up until now, we look at, as you've just said, we look at the vote split and we try and tease out from that how close each member was to voting for a cut or not voting for a cut, and exercising an awful lot of judgment in the process. Now, or at this upcoming meeting, you're going to hear a little bit more about what each one of them is thinking, and I think from that you will be able to ascertain how close each member was to voting for a cut. For the hawkish, for the likes of Hugh Pill, Catherine Mann, we know that they're probably going to be miles away from it. What's going to be much more interesting is how close the likes of Andrew Bailey and Sarah Breeden, who are they're basically the marginal voters. They're the swing voters, I should say, on the committee. If they go for it, the cut, then there's going to be a cut. Our baseline is they won't, but I'm just saying they're the 2 people to watch. So if you're going to read the minutes and take the time out of your day to do it, they're the two to look at and see how close they were to voting for a rate cut.
Okay, Dan Hansen, our chief UK economist, thank you very much. And we'll have full coverage of that Bank of England decision across our Bloomberg platforms. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Nathan?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, we'll look to new economic data out of China and what they mean for global markets. I'm Nathan Hager, and this is Bloomberg.
Okay, Canva can take your presentations to another level. It's super easy to use, but do you really know everything Canva can do? Let me walk you through some of the highlights. Take Canva Video. Whether you're a content pro or just starting, you can make standout videos right away. There are thousands of templates, a super simple editor, and AI-powered tools that let you generate cinematic quality videos with sound from just one prompt. It seriously couldn't be easier. Then there's Canva Docs. Create, collaborate, and share visual documents that actually make an impact. Reports, plans, whatever you need. And with Magic Write, Canva's built-in AI, you can brainstorm, draft, and even create copy in your own voice. And Canva Sheets? It's like spreadsheets if they were fun, which is maybe an overpromise because spreadsheets, but they're more visual and insightful, plus easy to generate. So whether it's a doc, a sheet, or a show-stopping video, Canva lets you bring your big ideas to life as fast as you can think of them. Put imagination to work at canva.com.
Hiscox Small Business Insurance knows there is no business like your business. Across America, over 600,000 small businesses, from accountants and architects to photographers and yoga instructors, look to Hiscox Insurance for protection. Find flexible coverage that adapts to the needs of your small business with a fast, easy online quote at hiscox.com. That's HISCOX.com. There's no business like small business. Hiscox Small Business Insurance.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
I'm Nathan Hager with your global look ahead at the top stories for investors in the coming week. Now we go to Australia, where core inflation accelerated beyond expectations last quarter, further complicating the path for further policy easing for the Reserve Bank of Australia. The RBA is set to issue a rate decision in the week ahead. For more, we turn to Bloomberg Daybreak Asia podcast host Doug Krisner.
Nathan, before last week's reading on Australia's inflation, money markets had been expecting the RBA to cut its policy rate. Well, then came the reading on core consumer prices, a gain quarter on quarter of 1% in Q3. And that seems to validate the RBA's assessment that its efforts to rein in core inflation have stalled. For a closer look, I'm joined by Bloomberg's James McIntyre. He is our economist for Asia in Sydney. James, thank you so much for making time to chat with me. To what extent were you surprised by that core consumer price reading?
Oh, we were quite surprised, as was everyone. So we'd anticipated inflation would be a little stronger than what the RBA had factored into their last set of forecasts that they made back in August. They're going to make a new set of forecasts with this in November ahead of this meeting, and that CPI data is going to result in them very much changing where their inflation outlook is, at least in the short term. The question is, though, what will it mean for the medium term? And that's going to be the kicker for policy down the track.
So help me understand what was particularly hot in contributing to this 1% gain. Are there areas that we can talk about here and where prices were kind of accelerating at a faster pace?
A few areas, some expected, some unexpected. On the expected side, there'd been a pickup in electricity prices a year ago, and 3 months ago there'd been some rebates from the government, and those no longer being there means that we're facing the real price now. So that's an expected tick up in inflation. But there was some prizes that we've seen in other places around the world, like New Zealand, in terms of holiday travel and accommodation. A little bit hotter prices there, and a little bit within the core, there's some signs that rental inflation, which had been easing, has bottomed and might be turning around. So there's a few things there that are temporary, some that are seasonal, and some that are worrying. All in all, an unhappy picture for the RBA.
So do we need to look at the other side of the coin and say that Australia's economy is doing reasonably well, perhaps stronger than people had assumed?
Well, when we look across the data, that's not how I'm seeing it. Consumer spending is still quite challenged, and if anything, it's sort of adding up along with a bit of extra slack in the labour market. Growth was not too much stronger or not too flash hot. All of those indicators are suggesting that the RBA does still have some work to do on monetary policy. The central bank does think that its current monetary policy setting is too tight. The question is really going to be about how gradual is this easing going to be? And the inflation data means that it's going to be a little longer.
Are you hesitant to use a descriptor like stagflation? Is that inappropriate?
Not yet. You could look at it in terms of unemployment rate is ticking up. It's only at 4.5, so it's still low, and inflation is a bit higher. But I think some of this inflation is, I hate to use the T word, transitory or temporary, but some of that's not really going to be with us over the course of the year ahead, and especially 2 years out, which is where the RBA is going to be thinking about when it's setting rates.
So where does the RBA go from here, in your view?
They don't go anywhere when it comes to the November meeting. And that means that we're starting to think about, well, what's going to happen in the new year. The next meeting after that will be in February in 2026. And what's interesting there is that they will extend their projections, including their inflation forecast, by another 6 months. So we've got a few more months of economic data, some of this inflation washing through, some signs that we really aren't getting the consumer spending pickup in the economy that we're hoping for, and another 6 months onto the projection period. In my view, our base case is that's going to be enough to get the RBA dragged into another gradual easing next year, and we see more cuts in 2026.
So what you know about sentiment, whether it's from consumers or on the part of businesses, what do those readings look like right now?
Yeah, so when it comes to sentiment, what we've been seeing is we had been seeing business conditions being okay, not too flash hot, but consumers still being pessimistic and taking a step back in the October reading. Not getting a rate cut in November, as many might have been expecting, is probably going to mean that those consumers are going to still remain quite depressed, especially when it comes to looking at their own personal circumstances over the months and the year ahead. So not a great impetus there on the consumer side of the picture, and that sluggish consumer spending pickup, that's ultimately going to be one of the factors that gets the RBA back off the bench and cutting again next year.
But I'm wondering whether or not, if consumer expectations for inflation do remain stubborn, that could further complicate matters for the RBA.
It could, but we're not seeing a labour market that's allowing consumers to turn any of those expectations into wage gains that are going to be problematic. If anything, we're seeing wages growth continuing to ease back, along with the RBA's expectations or forecasts for that wage growth to ease back. So we don't necessarily have a labour market and consumer inflation expectation dynamic that's going to be particularly spicy or problematic for prices, and could have cause some problems for the RBA.
So I know we recently had a meeting between Prime Minister Albanese and President Trump. I know you're an economist, and I'm not asking for political commentary, but are the animal spirits a little bit more alive in Australia after that meeting?
Well, it's a positive. We're all looking for, in these meetings, these bilateral meetings and these deals, for something good to come and a good outcome to come for our economy vis-a-vis the US. And that's definitely what we've got. Another big investment, co-investment with the United States to unlock critical materials. That's an important geopolitical flashpoint for the United States and for the world.
James, we'll leave it there. It's always a pleasure. Thank you so very much. Bloomberg's James McIntyre. He is our economist for Asia in Sydney. Let's turn next to the Chinese economy and look ahead to the trade data in the week ahead. Joining me now is David Chu from Bloomberg Economics. David, thank you so much for making time to chat with me. If you don't mind, I'd like to move beyond the details of the meeting that we just had recently between Presidents Trump and Xi. I'd like to better understand what's happening in the overall Chinese economy. I mentioned the trade data that we're expecting in the week ahead, and we know that the export economy in China has been very supportive of overall growth. Talk to me now about the markets other than the U.S. where Beijing has been building these trade relationships.
The thing is that China's export to the U.S. is facing significant headwinds. And if you look at the data, it has been dropping. But on the other hand, if you look at China's export shipment to the other trade partners, such as the Southeast Asia and Europe, you would see that these trade partners supported China's export over the past several months. If you look at what the government did, you can see that China is trying to build up a better trading relationship with these trading partners. We think that China's trade relationship with the other partners could be strengthened. And yes, from China's side, I think that is necessary. But on the other hand, to be honest, the other trade partners may be cautious about China's export because people have been talking about that China is diverting some export to the trade partners. So things could be complicated looking forward.
One of the things that we've heard a lot about when we study the manufacturing economy in China, and this is not a new concept, that overcapacity has been a real issue and a real problem. And it's been cited by many trade partners as being one of the ways in which China has been exporting deflation. Is that still very much a concern for the government?
Well, I think the overcapacity itself is a concern for the government because China is facing a sluggish demand, especially in the domestic consumption. So that the government decide that they are going to do something to restrain the overcapacity, because such as they decide that they are going to do something anti-involution. But on the other hand, we have to say that it could not be easy because if you look at what happened back to about 10 years ago, that overcapacity reduction in China actually led to some great pressure in the job market. So that now is a dilemma for the government. So on the one hand, they do want to cut the overcapacity. On the other hand, they have to take care of the labor market. So that given all of this, I think the government has to take a gradual pressure on this front. So, but this may not be a good news for the trading partners. Because of the weak domestic consumption, China has to rely on the export more than before, so that other trade partners may feel that China is exporting more and more lower price goods to them. But for China, I think that is the choice of no choice.
One of the things that we have seen a lot of recently in the U.S. has been aggressive spending on artificial intelligence. And I'd like to get your take on what you're seeing in terms of the AI spend in China right now and the degree to which the government is almost encouraging, fostering this type of spending.
Yes, you're right. I mean, the government is encouraging the development in the AI side. If you look what happened over the past week, that China just had the 15th five-year plan proposal disclosed, and the government emphasized the development of high tech, including AI. They think the new industries led by AI and other such as semiconductors and other new sectors can be the new engine for China's development in the longer future.
David, we'll leave it there. Thank you so very much. David Chu there from Bloomberg Economics. Also in the week ahead, we'll get the inflation data for South Korea. Now, these numbers will be released as the Bank of Korea considers adding to its gold reserves for the first time in more than a decade. Last week, the BOK said it would monitor markets to decide on the timing and size of any gold purchases, and a decision would be based on the evolution of its international reserves and the trajectory of gold, as well as the direction of the Korean won. We'll look out for that in the days ahead. I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.
How can you free your team from time-consuming office tasks? Amazon Business empowers leaders to not only streamline purchasing, but better support their teams. Smart business buying tools enable buyers to find and purchase items fast so they can focus on strategy and growth. It's time to free up your teams and focus on your future. Learn more about the technology, insights, and support available at amazonbusiness.com.
Did my card go through?
Oh no.
Your small business depends on its internet, so switch to Verizon Business. And you could get LTE business internet starting at $39 a month when paired with select business mobile plans. That's unlimited data for unlimited business.
There we go.
Get the internet you need at the price you want. Verizon Business. Starting price for LTE business internet, 25 megabits per second unlimited data plan with select Verizon Business smartphone plan savings. Terms apply.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/stories.